Hello, everyone. So today we are talking about dividends and why they are really important as you are investing in the stock market. So first, let's talk about what dividends are exactly, in case you're not familiar. So dividends are essentially a way for a company to take a portion of their profits and give them to their shareholders and investors. And so first things first, not every company pays dividends, and whether they pay dividends or not can change over time. You will have companies when they are first on the market, they've done their IPO. Most times they're not paying dividends, right? And then usually it takes quite a few years before they are profitable enough to pay dividends. And, they will announce when they start doing that, but the opposite can happen as well. You can definitely have companies who once pay dividends and then they have stopped. So I'll give a few examples. So Delta, they have been known to pay dividends, but during the pandemic, when they were going through financial issues like many other companies, they did receive some government assistance, and therefore part of that stipulation, well, the stipulation to receive that those the aid, they had to agree to stop paying dividends to investors, which makes sense, right? If you are having financial issues, how are you paying out cash to your investors, right? That doesn't make sense. So they did stop paying dividends for about 3 to 4 years, and then they ended up resuming paying out dividends, which I believe began back in 2024. And so you have companies like Disney, they also used to pay dividends. They have since stopped. Let me double check to see if they've resumed. I don't think they've resumed paying dividends. Let me just double check before I misspeak. So while I'm doing that, you also have companies who never paid dividends, who then began paying dividends. So for example, Meta, they definitely went public quite a few years ago, but they have not been profitable enough to pay dividends. So now they actually do pay dividends, which is of course a very attractive proposition for investors. And I'm trying to find my Yahoo Finance app, and I'm having, okay, maybe it's not on this phone. Hold on one moment, please. There we go. Okay, let's check Disney. So I'm actually on the Yahoo Finance app, and I like to use them to do my research when it comes to stocks. So, okay, so Disney has resumed paying dividends. They pay about $1 for the year, so essentially 25 cents per quarter. So these are examples of different scenarios that you can see when it comes to dividends. Now, usually when a company is paying out dividends, it means that they are profitable enough to do so, and they are taking part of their profits and paying it back to their stockholders or shareholders as a thank you for investing in a company. Now, I will have to say, many, many moons ago, when I first started investing in the stock market, I heard dividends a lot. I heard people really talking about them in a positive way. When I looked into it, I was like, it's not a lot of money. What is the big deal? So you might feel like that right now, and I will hopefully by the end of this conversation convince you as to why dividends are important and why you should consider investing in companies that do in fact pay dividends. So let's use Disney for example, right? So right now they're paying their shareholders a dividend of $1 for the entire year. So every single quarter in which you own a share of Disney, you will receive 25 cents. Now, the 25 cents in itself isn't a lot of money in the grand scheme of things, but where dividends become lucrative is in the long term strategy. So, when you receive that dividend payment, you as the investor must decide how to handle that cash. You can either have those funds deposited into your account and you can either cash it out, leave it in the account, or you can reinvest it. Now, what most investors will do, they will have those cash payments reinvested in the initial or original stock. So, for example, when you receive that 25 cents from Disney, your brokerage account, as long as you agree to it, they will take that money and buy a fractional share of that same stock. And so now what will happen is every single year, not only are you receiving dividends from the company, that money is now being used to buy more shares. And as you increase the number of shares that you have, you're now going to qualify for more dividend payments. So you see how over time that can definitely snowball. The more shares you own, the higher of the dividend payment, which means now you are in turn going to receive more shares, which will then cause you to receive more dividend payments, so on and so forth. So you see how that can actually work in your favor. Now, of course, if you're just buying one stock, you're not going to really feel the full impact of that. But as you start to increase the number of shares in your portfolio, that is when it is going to start to make a financial difference. Plus, the longer you are invested in the market, you will really start to feel the positive impact of that. And so for a lot of investors, they look at this as a long-term strategy to create income for themselves. So if you are someone who is going to invest in the market for 20, 30, 40 years, and you are slowly but surely adding stocks to your portfolio that pay out dividends, over time, that can add up to hundreds or thousands of dollars of just dividend payments you're going to receive every single month. Now, again, it's not going to happen overnight. It is going to take time, but again, if you want to be a great investor and really see the benefits of playing the long term, right? This is kind of what part of that strategy is going to entail. Now, of course, not all dividends are the same. They are not all created equal, and I'll talk about what that actually means in just a second. So when it comes to how much dividend a company pays, there isn't a set requirement per se. So the company actually decides how much of a dividend they're going to pay out to their stockholders. They also agree on whether or not they're actually going to pay dividends as well. Now, for most companies, once they've established that they are going to pay dividends, they do try to make sure they can do that for the long term. Now, of course, there are attenuating circumstances that may get in the way of that, aka a pandemic, right? But they never want to commit to paying dividends only to not be able to afford to do so down the road because it just does not look good to Wall Street, right? When a company is committing to paying dividend payments, that means one, they have the cash to do so, but two, it means that they feel that the company will be financially stable enough to sustain this for perpetuity in theory. So usually when a company announces that they are now going to go from paying no dividends to now paying dividends, Wall Street definitely looks at that positively. And not only will it now attract more investors, the stock price normally will take an uptick or increase in value as well. And the opposite holds true too, right? They go from paying dividends to not paying dividends. That definitely is a red flag of financial trouble potentially. And so the market usually responds negatively, and the stock price will usually take a hit. So when you think about investing in the stock market and you're looking for certain companies to invest in that pay dividends, you want to look at something called a dividend yield. That essentially just tells you how much of a dividend they are paying in comparison to the price of a stock. And again, not all dividends are created equal, and I'll give you some examples. So if we were to look at a company like Apple, and I have to find a way to share my screen so we can look at this together, but we'll just make do for right now. So Apple right now is trading at $214 per share. And so when it comes to their dividends, let me show you guys that. Hopefully you can see it. They pay, well, it's kind of blurry. They pay $1. Ooh, there we go. They pay $1 for every one share that someone owns. So the dividend yield on that is 0.47%. So it's well below 1%. Hopefully you guys can see that. So if I look at a company, for example, like AbbVie is a company in the pharmaceutical healthcare space. Their stock is also in that same ballpark as Apple. It's about $214 per share, but their dividend is a lot higher. Hopefully you guys can see that. We will try to figure out how to share our screen for the next live, but their dividend, it's kind of blurry. Hopefully you can see it's about $6.56 for every one share, making that dividend yield 3%. So you see that is a huge difference. So if you buy one stock of Apple, you're only going to receive $1 worth of dividends for the entire year. Whereas AbbVie is in at a very similar price point. They're paying a lot more. You're getting almost $7 of dividends for the year. So this is why the dividend yield is super important. It really is a simple formula. It is the dividend divided by the stock price, which is how you get to the percentage. Very, very simple way to calculate it. But that's why I like Yahoo Finance, because they do the math for you. You don't have to do the calculation yourself. I'm using their app right now. It's very user friendly. I love to use it to do research on the go. So this is why you want to pay attention to things like that, because you might love a certain company like Apple, excuse me, and you're looking to buy their stock for dividend payments. As you can see, Apple is not known for paying well when it comes to dividends, right? They're known for the value of the stock because the company sells products that are in high demand. They're very well known in their industry. They're a market leader, right? So you're buying that stock more so for the value proposition and the fact that you hope that the stock price will increase in value over time. Whereas a company like AbbVie, the same could apply, right? You could invest in that company because of the value proposition, but they also pay a very healthy dividend. And so when you are looking to invest in companies for dividends specifically, you want to pay attention to the dividend yield to understand, well, how much of a dividend am I getting versus the price of the stock that I'm actually buying? So it's really important to pay attention to that. Also, companies can change how much they are paying when it comes to their dividends. They can increase it, but unfortunately, they can also decrease it. So you will definitely see that happen as well. So definitely, it's really important to pay attention. And luckily with Yahoo Finance, they do have a way for you to look at that. You can look at the historical dividend payments, so you can see, how long have they paid dividends? Have they increased it? Have they decreased it? It's really telling, because if a company is decreasing their dividends, it might mean they are dealing with financial trouble. And the opposite can hold true too. If the company is increasing or has increased their dividend payments, that means the company is doing well. They feel like they have financial stability and they are in a position to increase the dividends they are paying out to their investors. So really, really important. Now, I kind of touched on it a little while ago, but I want to kind of go back to it. So when you have a brokerage account where you are investing in the stock market, you're buying stocks actively, and you are receiving or will receive dividend payments, if you are interested in having those dividends reinvested in the original stock, meaning when that money comes in, your brokerage company is going to buy more shares of that stock, you must opt into that. If you do not opt into that, what will happen is when the dividends are paid out to you, it's going to just sit in a cash account, meaning it's not going to be invested in anything. It's going to sit in that cash account. It may earn a little bit of interest depending upon what brokerage firm you're with. And that money is just going to sit there doing much of nothing, right? So make sure whatever account you have, make sure you are logging in, going into your account settings. It'll be something like that. And there will be a section for dividends, and you will see an option for to turn on the feature to reinvest those dividends. Now, if you are an active investor and you know when that money comes in, you want to dictate how it's invested, by all means, go right ahead. I definitely don't want to discourage you from doing that. But if you are someone who is on the more passive side when it comes to investing, you're not always logging into your account to pay attention, you don't really know how to, let me not say that. You're not active in that you're actively making investments every single week. You're looking at it every single day, right? You're really in this account all of the time. If you're not that person, you are better off just having those dividends reinvested. So that way it is happening for you passively, without you having to worry about what to do with that money when it comes. Now, of course, down the road, when this money is substantial, it's hundreds or thousands of dollars, and you would prefer to determine how that money is spent or invested, then you would turn the feature off and go ahead and make those actions based upon whatever your strategy is at the time. But right now, starting out, you are better off just having those dividends reinvested automatically. So that way you don't have to think about it whatsoever. Now, when it comes to dividends, the timing of when you own the stock does make a difference. So there's something called the ex-dividend date. So you must own the stock the day before that ex-dividend date in order to qualify to receive that dividend payment. So let's say company ABC is paying dividends on April 1st, right? Or the ex-dividend date is April 1st, excuse me. That means you must own the stock before April 1st to qualify for the dividend payment that will be paid upcoming weeks. So really pay attention to that. I know some people have been disappointed in what has happened with that. They're buying the stock because they know it pays dividends. They know the payment went out and they didn't receive anything. It is because you didn't own the stock in time. That's really what that means. But once you do own the stock, and let's say you missed the cutoff, the next go around of when the dividends are paid out, you will receive that dividend payment. But when it comes to the ex-dividend date, that is the date that the company is going to pull the list of all investors that own the stock by that date. So you must own the stock by the day before in order for your name to be on the list so you qualify to receive the dividend payment. So a small nuance to pay attention to. Now, if you're in this for the long haul, it's not a big deal. But if you are trying to time it to where you're getting the stock, the dividend payment just in time, you want to pay attention to that. But I think for most people, that's not that big of a deal, but just something to pay attention to, just FYI. Now, something else I did want to talk about. We discussed dividend yield. We discussed Yahoo Finance. So the other thing is, depending upon how much you receive in dividend payments, it can be a taxable event. So if you are looking to make a sizable investment in the stock market, definitely talk to your tax accountant to make sure that you are covered, from all bases. You never want to find yourself in a place where you're surprised that, hey, I have to pay taxes on this, or it's a taxable event, or there's a tax liability. So just keep that in mind as you're moving through your investment journey. Now, regardless of what platform you are using to make your investments, there should be a way for you to do your research in that portal to understand everything I mentioned about the dividends. But if not, you can definitely check out a platform like Yahoo Finance. Again, I find it to be very user-friendly. This is not sponsored by any means, but I find that you can look up so much in this app. You can look up the company's financial statements. You can look up their you can look up the 52-week range, which just means the lowest and highest price the stock has been in the last 52 weeks. You can look at dividends, dividend yield, earning per share, market cap. There's just so much right here in this app. And you can look at charts as well. So that's why I do really like this platform. And it's free, right? You can pay for an upgraded version to look at more information. But for the average person, what they're giving for free is just enough. And they also have articles in here about the company that can kind of help you understand what's going on real time. So I like to use it. And you can have your stock watch list. So certain stocks, when they're making movements up or down, you can be notified of what's going on with those stocks. So it's really great. I really like it. Also with this app, if you're looking for index funds, for example, we'll talk about that in a second. You can also see what companies are in the index, so on and so forth. Now, when it comes to index funds and mutual funds, those also can pay dividends as well, right? So when you think about an index fund, it's basically where it's a basket or mini portfolio of stocks within this index. And so if any of the companies within that portfolio pay dividends, that means the index fund itself will also pay dividends as well. So something to also pay attention to. You don't have to invest always in individual companies. You can invest in an index fund and then still receive dividend payments, which is pretty cool. Now, when it comes to fractional shares, let's talk about that quickly too. So let's say you want to buy Apple. We'll go back to Apple for this example. The stock is about $213 per share, but let's don't quite have $200. You only have, let's say, $100. So because stock pays a dividend and you own a fractional share, you will qualify for a portion or a fraction of the dividend payment as well. So in this example, we only have 50% of the money to buy the stock. So we would get 50% of the dividend payments. That's why fractional shares is also so powerful. and that you get the benefits of a stock owner without having to own a full share of the investment. And this is why, regardless of what budget you have right now, you really should look at investing whatever you can for as long as you can, so you can see the value in the long term, in the long run. Unfortunately, too many people look at it as, well, I don't have a lot of money, so I shouldn't bother, because what's the point? Well, the point is, having some money in the market is better than having no money in the market. And that's really how you have to think about it. Instead of thinking of it as the glass is half empty, think of it as the glass is half full. We have to have a positive spin on investing and money and things like that. So doing what you can with the smaller budget, it's going to set you up for the long run, because once you start making more money and you have more money to invest, you already now have the habits and the knowledge. So now you can make better investment decisions, because now you have more money to do so. So really think about that as you're moving through your investment journey. Don't look at it as, I'm only investing $20. Say, oh, I have $20 to invest. This is great. What can I do with it? And the more that you look at it in that light, you will find that money will start coming to you, and just your mindset will shift. And then you tend to be more focused on the positive versus the negative. And that's the best way to approach investing, in my opinion. But unfortunately, too many of us look at it in the other way, in that I don't have enough. Why should I bother? It's not going to be a big deal. Not the way to approach investing whatsoever. So when it comes to dividends, definitely look into adding that to your investment strategy. Companies that pay dividends tend to have longevity. Again, they're profitable enough to afford to pay dividends, which also is a great sign as an investor. But also, don't take that for granted either, in that you should still pay attention to what is going on with the company. Look at what's going on with dividend payments. Are they increasing it? Are they decreasing it? Are they stopping it altogether? Right? These are all indicators as to what is going on with the company's financials and their overall health. So definitely keep that in mind. So that's it for today's live, guys. Talk to you next week, and I will schedule that. And then let me know if you have any questions in the comment section down below. Take care.